So hi everyone, thanks again for joining us today, and thank you Azam for speaking. It's great to have you. So Azam brings extensive and diverse operating and boardroom experience beyond the CFO suite. His experience spans public, family-owned, and venture-backed companies in the technology and manufacturing space. Azam's experience includes 2 venture-backed technology companies with finance and operations responsibilities to help grow and successfully complete the sale of the business. He's currently CFO of Devhaus Technologies. Azam has completed his executive MBA from the University of Toronto's Rotman School of Business and is a chartered professional accountant, CMA, CPA in Ontario. Thanks again for presenting today, and good luck.
Thanks, Alex, and good evening, good afternoon to all the participants, depending on where you are, and maybe some good morning as well. What I'm going to do is walk through basically a practitioner's view of financial modeling for technology businesses, young technology businesses that are SaaS-based or subscription-based. They may not necessarily be pure SaaS, but they may still have a subscription model. And my presentation is not PowerPoint heavy. It's just there as a prop to speak to. And what I intend to share is some thought processes behind the financial modeling. It's not so much about creating the model itself and the mechanics involved, but it's more about what do you need to think about, what has worked for me so far, what I've done in the past, and that's where I'll begin. So in a moment, I will share my screen and take you to the PowerPoint. So basically, it is for a young software as a subscription technology business, that type of business. It may not necessarily have, it could apply to something that is not pure SaaS, like you could even be selling on-premise software with subscription-based revenue billing. So it could be any of that, but you could still use this kind of model. This is not so much about manufacturing and not so much about services. It's more about technology and software. So the key considerations when you start building up your model, I mean, this is the starting point. Who is the audience and what is the purpose? Your audience could be many of possible audiences. It could be the bank, it could be lenders, it could be venture capital folks, it could be angel investors, or it could just be strategic partners that you're trying to kind of connect with and kind of do business together. Also, what is the purpose of your financial model? Are you raising capital, and then is it debt or equity? A debt provider looks at financial numbers from a different angle compared to an equity provider. Debt provider is looking for strength in the balance sheet. He's looking for security for that debt. Whether it's a secured debt or not, they're looking for the ability to pay back. Looking for your ability or your business's ability to pay back, whereas an equity provider is looking for growth and eventually want to exit at some point. So they want to see, okay, what is the exit strategy? In whatever case, whether it's for any of these audiences or for any of the purposes, your purpose through the financial model is to build confidence in the numbers and therefore the business. And therefore, what are the key characteristics of the model to be able to achieve that? Credibility of the assumptions is key. So one has to be able to explain and defend the assumptions, and they need to be supported where possible by external sources. Now, if you're a young company, you don't have in-house experience about the product and run rates, etc. So therefore, you look for comps and you look for external sources. You've got to demonstrate the internal consistency based on, let's say, accounting principles. For example, you have revenue recognition in a subscription-based business, but it may go, there is another leg that goes into the deferred revenue. It offsets over there. If you're billing subscriptions on an annual basis in advance, you've got a piece of the revenue sitting in deferred revenue that needs to be drawn down every month. So how does that kind of fall together? That is the one example of internal consistency. The ability to see cause and effect through formulas. So when we build Excel spreadsheets, it's important that an Excel reader with ordinary Excel skills can understand and follow through the trail of the formulas. Use of macros and sophisticated formulas doesn't always make it helpful to kind of convey how the numbers are flowing. You also, at the same time, need to be able to make changes quickly, because in a young company, things are evolving constantly. So whilst there is a limit to the automation that you want to impose building in your spreadsheets, you also want to keep the ability to be able to make changes quickly. So don't over automate. Your assumptions need to be driven up from the ground up. Very often I've seen metrics as the end goal, as they factor in as assumptions. So a lot of the numbers sometimes are driven by the end goal, and that doesn't seem right. You got to build the assumptions ground up and build your numbers, and then see if the metrics make sense. Are you seeing the necessary outcomes that you wanted? And then go back and tweak the assumptions, or see what's wrong with it, or tweak the numbers, and so on and so forth. And at the end of the day, this model is going to be wrong, because it's a model, it's a forecast, it's a projection. So reasonable accuracy. So it's not about being accurate, it's being reasonably accurate to be able to defend what you're doing, and it needs to fall together logically. So the purpose of the model is not to demonstrate advanced skills in Excel or graphics. It's about being able to defend the assumptions, explain it and defend them, and build trust and build confidence in the numbers you're showing. We don't need sophisticated tools, in my mind. And again, this is a young company, not mature business. It's SaaS based. Your pricing models are changing. Your revenue history is going to change. So it needs to be what you see at that point in time. And we don't need excessive automation. Quite a few manual plugs are also acceptable. So that's basically the context or the key considerations over for models. How do I build the model? I see the model as a bunch of Excel files, essentially covering revenue, people, expenses, fixed assets, and then bring together into the financial statement. I will talk about each of these in a little more detail. So insofar as revenue is concerned, this is a SaaS business. So you need to think of MRR and ARR. Think of your pricing model. Is it based on a per user base, or is it based on a per customer? Is it a license per month, or is it being billed out on an annual basis? You got to factor all of those things. Or are you selling software on a per site basis? Can you estimate your customer size based on the number of users? All customers are not uniform. So you got to think about it and say, okay, maybe you got a mix of small, medium, and large customers. Define your small, medium, and large customers by how many users they may have. So that way you've mitigated the risk of, averaging out across the whole customer base that you anticipate to capture. And then what is the arrival rate for each of the customers? Small customers may arrive fast, but they may also churn fast. Large customers may arrive slowly. So you got to build that into your model, into your revenue model. Then think about, will a customer expand? Does your product support a land and expand strategy? Is your product sticky? So what is then the expansion rate that you might assume? You look at comps, you have some assumptions, you look at what you want to achieve. Once a customer arrives, will they expand organically, or do you have to wait for them to expand through acquisitions? And will you get more through that process? Will you have new products that you will be able to sell to them? That's upsell. So that's also part of expansion. Look at your product roadmap and see what new products are there in your business plan, and would you be able to sell to the same customers? And if you have a short history, this may be of limited use, but you got to imagine when you go out to the street, say, for example, that this is how you're going to build your business with relevant assumptions. And you got to be able to defend the assumptions. And again, conservatism is fine, but you got to balance it with some bold assumptions as well. Then you think of the stickiness of the customer. Why would a customer churn? Why will they go away? How long will they stay with you? Think of your product. What industry verticals are you selling to? So if you were in the hospitality industry, you would have anticipated in your forecast, in your model, churn in your product sales or subscription because of what's going on these days with regard to the pandemic. But if you were in a software industry, which is not selling to the hospitality industry, you might have a different view on that. So typically I've seen churn rates anywhere from 5% upwards, also depending on what kind of software it is and what industry you're selling to. So that's some thoughts, some tips on the revenue model. What do you need to think about? The other is the people model. And you got to think of the roles and functions involved: engineering, sales, marketing, so on and so forth. Do you need heavy management, VP level people, or do you need a lot of doers? What are the recruitment fees? Are they going to be on contract or full time? So you got to have fully loaded costs, including benefits for full time employees, and contract employees. You have some leeway over there in terms of switching them on and off. If you've got a sales force, then you've got to think of bonus for the employees and the sales comp. Those are variable comp. So you could create a pool based on some assumptions. You don't really have to have the details of the comp plans, but you can create a pool and say, okay, I'm going to create a pool for, let's say, 10% or 20% of base pay as bonus pool. And these days, you got to also actively consider how is going to be the office and work routine. Is it all home based? Is it a hybrid? Is it fully office based? And therefore factor in the necessary real estate costs that you may have to. Expenses, and that takes me to various heads, but I would typically find myself grouping expenses into travel, marketing, communications, office or establishment, where I put in legal, professional, and insurance costs. And for a SaaS company, don't forget cloud usage costs. They could be a big one, especially if you got to host a software on AWS, Google, or Azure. You could run into huge costs that you did not know. So there needs to be some skills within the organization to also manage the cloud costs. And then, of course, comes the fixed assets. If you're based in an office-based culture, you've got to think of laptops and furniture. Whereas if you're home-based, you're probably providing laptops to your employees. And then what about data center? If you need a lot of, is everything going to be in the cloud, or do you have some on-premise data center? So you got to think about all of that. And these are questions that I've noticed entrepreneurs, when they start the business, they haven't really thought through. It's through this process of financial modeling that have that discussion. And we, as of experienced finance folks, we are able to guide the thinking, ask the questions, and then build a model that is consistent with the business plan. And a quick note on formatting: I like to see all the Excel files as monthly, and then quarterly, and then total. So 12 months, and then Q1, Q2, Q4, and then total for the year, and then subsequent year again, 12 months, and so on and so forth. The reason I do that is standard formatting across all the files, and these are all separate Excel files. And the reason I keep them separate is revenue separate from people is separate from expenses, only because people costs are more confidential than maybe overall expenses. You can pull in the aggregate people costs into the expense files, whereas you can, at the same time, keep the underlying detail with individual payroll amounts confidential. Similarly, for revenue, you may want to share certain things, you may not want to share certain things. But what you're definitely going to share is the financial statements. That's the income statement, balance sheet, and cash flow. So that sits separately so that you can quickly share it. Most often, people who want to scrutinize your model want to look at the Excel, want to understand it, they want to play with it. So it's easier to send just the income statement and balance sheet and cash flow to them. That kind of hangs together, but it does pull numbers from the expense file, people file, revenue file, and so on and so forth, without showing the gory details. And then you have the financial statements. This is where it all comes together. You got to step back and take an overall look. And the first time you look at it, you may not like what you see because you didn't have a full view. When you build it bottom up through assumptions, you got to start testing it now and say, okay, is this what you want to present? Does it tie in with the story? Is it consistent? Check roll forwards for receivables, deferred revenue. By roll forwards, I mean opening balance plus what comes in minus what goes out. In receivables, invoicing comes in and collections go out. That's kind of the roll forward I would look at it. And that keeps it consistent internally within the model. And important to do all the 3 bits of the financial statement: income statement, balance sheet, and cash flow. I've often seen shortcuts where only the income statement is done. And that is a hazard, because you could find certain things don't balance up when you've just done the income statement. When you go into the balance sheet and eventually into the cash flow, you can detect your own errors of judgment, or purely Excel maybe. So you step back, take a look, and then look at the growth rates and metrics. Do they make sense? Is this what you like? Is it comparable to market? And if not, you got to go back and tweak the assumptions. And therefore, what I said earlier, metrics are top down. They are outcomes. They're not something that you build a model from. They are the outcome of the model assumption. So this way, when you go back and forth to get to the metrics that you desire, you can then test your assumptions. Are they realistic or not to get to the metrics? Are we spending too soon or too late compared to timing of revenue? Are we hiring salespeople before the product is ready? What is the product roadmap? So those are the kind of thought process you got to go through, and then keep tweaking this model and reiterate as many times as needed till you get to kind of a happy place, so to speak. And there's not really any one happy place. It's just reasonably happy place. And then I take you to the metrics. In a SaaS business, MRR, ARR are key. MRR stands for monthly recurring revenue, and ARR stands for annual recurring revenue. MRR keeps changing as you add new customers and you renew and you change. It changes from month to month. Therefore, the ARR, if you're running a calendar year, the MRR times 12 is typically ARR, obviously, but it depends which month you multiply by 12. You end the year in December, so you take the December MRR and multiply by 12, you say you are X $1 million ARR business. But if you take the January MRR and multiply by 12, you're not that, you've grown since then. So that's something to bear in mind. And you try to map your revenue into new business, renewal, churn, and expansion. Churn is customers leaving, or reduction in revenue. So if you if you sign up a new deal for $100, it should renew at the end of the year, assuming a 1-year subscription, for another $100. If it renews for $90, means you churn $10. So that's your churn rate. However, it could even expand to $120, and that's your expansion rate. So you look at it across the whole customer base and look at the whole cohort and say, okay, on an average, my renewal rate is so much and my churn rate is so much, expansion rate is so much. And by renewal rate, I mean net renewal rate, which is 1 plus churn, 1 plus expansion minus churn. So that gives you the net renewal rate. You add in the expansion and you deduct the churn and you get the renewal rate. So for example, if your churn rate is 5% and your expansion rate is 20%, the net is 15, and therefore your renewal rate is 115%. Then you look at your annual growth rates. Growth is key for any software business, for all businesses. And if you want to finance it, growth is the story you got to tell. Cash flow from operations and EBITDA. In a SaaS business, cash flow and EBITDA are 2 separate things. They may not necessarily be a proxy for each other. And that's because in a subscription business, if you charge annually in advance, you collect cash sooner than when it flows through the income statement into EBITDA based on revenue recognition principles. You also want to keep track of customer count and paid user count. And at the end of the day, on an average, what is your price per user per month? From a SaaS perspective, the key SaaS metrics, I talked about it briefly already: expansion rate, churn rate, retention rate, and net renewal rate. So churn rate, retention rate are reciprocals of each other. If you're churning at 5%, your retention rate is 95%. So a renewal of $100 renews for $95 means you've got a 95% retention rate or a 5% churn rate. If there is an expansion rate of 20, like I said, the net renewal rate is 115. 20 expansion, 5 churn. Now, mind you, it's not the same customer that is expanding and churning at the same time. We're talking of aggregate customer base across all the customers you may have, 200, 10, 5,000, whatever it is. So that's at an organizational level. And then as the business grows, you talk about CAC and LTV. CAC is customer acquisition cost and LTV is lifetime value. And these are critical when there is critical mass. At the early stage for a young software business, young SaaS company, these are difficult to come by. In fact, you're investing a lot. But what they mean, customer acquisition cost is essentially sales and marketing expense for new business on a per customer basis. It's hard to figure out what you're spending on sales and marketing for new business alone. There are certain things you can identify. There are certain things you got to allocate. So that's one, because your business not only supports new customer acquisition. In the early days, it would, but as it matures, it does not only support new customer acquisition, it also supports the existing customers. So you do certain things to maintain your presence, maintain the customers, and those are not part of the customer acquisition cost calculation. Lifetime value is you got to think about what is the value of the customer over its lifetime. If your churn rate is 5%, your lifetime value is 1 divided by 0.05. That's about 20 years. The lifetime, not the value. And then you got to think of what is the average deal size. So 20 times average annual deal size gets you to a lifetime value. And you want to make sure that you compare your lifetime value of a customer with the customer acquisition cost and make sure that you're getting more over the life of the customer than what you spend on acquiring the customer. And that's where a rule of thumb I've seen, CAC to LTV or an LTV to CAC ratio of 4 times, 4.5 times is acceptable, is exciting to the external financial gurus that look at your business. And I guess that's where I will end and maybe take any questions or give you a few minutes.